Hello everybody, welcome back. This is part 2 of the video series for Course 101 Introduction to Futures Markets. In part 2 here we will discuss calendar spreads and the basis trade. But first, let's go back to the risk disclaimer. Everything discussed in this video and all content on MarketMentor.io is for educational purposes only. I am not in any way providing financial advice or soliciting financial products. Trading futures markets carries significant risk and can result in loss of capital. So we can dive right into understanding calendar spreads by pulling our TT platform back up. And to introduce the concept, I am going to pull up the MD Trader window and I'm going to search for gold again. We'll pick it up with gold as we left off from part one. And we're going to pull up a gold futures market outright. And we're going to pull up the December contract, which is the most active and liquid contract trading right now. We're going to take a look. We have bids and offers here. The price is 1977.6, roughly, maybe zero point 0.7. And to understand a calendar spread, we must grasp the concept that a calendar spread is the price differential between two futures contracts. So here we have one futures contract, the gold DEES 20 outright market. And to find a spread, we're going to look down the curve and we're going to pull up another futures outright market for gold, and we're going to pick February 2021 as our leg 2 of the calendar spread. So the calendar spread, as we talked about, is the price differential. It's leg 1 minus leg 2 in a conventional pricing format. There are calendar spread markets that are leg 2 minus leg 1, which just inverts the math, but it's the same principle. It's the price differential between two contracts. The traditional way of pricing these spreads is leg 1, in this case gold DEES 20, minus leg 2 gold February 2021 for this example. To further grasp our concept here, we're going to pull up the listed calendar spread market for gold DEES 20 gold Feb 2021. I'm going to look into my listed calendar spreads here and go down and find the one I'm looking for, DEES 20 Feb 2021. I'm going to pull that up. So now we have enough information here to really dive into this concept. Gold DEES outright market, gold Feb outright market, gold DEES Feb spread. The way they are, you see bids and offers here in the listed calendar spread market, and you wonder how the traders are coming up with these prices. They're simply doing the math. So they're doing the leg 1 minus leg 2, and they're finding a mid-market price of minus 9.5, and they're bidding minus 9.6 and offering minus 9.4. So what does that mean? If you're bidding minus 9.6 in this listed calendar spread, conventionally priced, you are attempting to buy the gold December 2020 outright market at a discount to the February 2021 outright market of $9.6 per contract. If you are offering the listed calendar spread market at minus 9.4, you are looking to sell the gold DEES 2020 outright market at a discount to the gold February 2021 outright market at a price of minus $9.40 per contract. So, pretty simple arithmetic to figure out how we're getting to these prices. To explore deeper into calendar spread markets, we will now talk about contango and backwardation, which are two common words you will find when you're researching the topic and looking to understand further. Contango, and we're going to pull up a section from the book Introduction to Futures Markets, and we're looking at page 72 here. A market in contango is demonstrated in this graph, and this is a Bitcoin example. I believe that's the only example I used in the book was the Bitcoin forward curve. But the concept applies across all futures markets. So a forward curve is plotting the listed contract months that are actively trading onto a chart and then plotting the prices for each of those contract months at any given time. So in this example, we see Jan, Feb, March, April, May, June contract months and the associated prices, and we notice that near month contracts are trading at a discount to deferred month contracts. And another way to say that is deferred month contracts are trading at a premium to near month contracts. Why would that be? What would cause a futures market complex to trade in a contango structure that we are seeing here? And if we come back to TT, we notice that the gold DES is trading at a discount to gold Feb. So we're in a contango structure here as well. Why would a market trade like this? One thing to understand is the concept of cost of carry. If you are, let's go back to gold as we're active in that right now. If you are a gold miner or a gold distributor, you have a cost of storing gold. And if you're not selling your gold into the spot market, let's use a distributor as an example, you have to place unsold gold into a vault to be sold at a later date. To store gold in a vault comes with a cost, and that has to be priced in on a futures market forward curve. You have to price in the cost of carry, the cost to store an asset to be delivered at a later date. The another factor that can come into play is transportation costs. That can factor into cost of carry calculations along with interest rates. So interest rates are historical lows currently. They're not being factored in too heavily, but we are seeing a contango structure between gold DES 20 and gold February 2021 of, let's call it, a mid market of $9.50 per contract, and the contracts are denominated in ounces, dollars per ounce, excuse me. So $9.50 per ounce of gold is what's being priced right now. To to move on from contango, there must be an inverse, and that's going to be backwardated markets. So we're going to skip to page 78 here to take a look at a backwardated market forward curve. And you notice it's a negatively sloping curve. We have the same listed contract months here: Jan, Feb, March, April, May, June. And we notice near month contracts are trading at a premium to deferred month contracts, or another way to say it, deferred month contracts are trading at a discount to near month contracts. What might be some reasons for a futures market complex to trade in a backwardated structure? There are many speculative reasons that a trader or a market participant could come up with. One that is worth focusing on is spot market demand. If the near month spot market, in this example January, finds an increase in demand for the asset, that means more buyers are coming into the market and willing to pay up for access to the asset today in the spot market, we might find that the front month contract begins to trade at a higher price than the deferred month contracts. And this is simply the demand coming in to the spot market, lifting offers, raising the price relative to deferred months. So that is an example of a reason why a market might flip from a contango structure where near months are trading at a discount to deferred months into a backwardated structure where near months are trading at a premium to deferred months. And that can happen in all markets. Gold, even though gold is in contango now, if a surge in demand for gold, especially for spot gold, comes into play, the spread could begin to flip. And I think that's a good point to transition into tightening and widening calendar spreads. So if we look at our gold December 20, February 2021 calendar spread, we see we're at a mid-market price of minus 9.5. If this spread were to what we say tighten, it would begin moving towards zero. So buyers would come into the spread. They would be bidding up gold December relative to gold February 2021, which would bring the spread towards trending towards zero. If we think about what that means, if you look at the prices here in gold DEES and gold Feb 1981, 1991, let's call it roughly, and then you have the decimals in there to make that 0.5. If the demand for December comes in but nothing comes into February, the price here 1982.1 will start to trend higher, although February will not be moving so much, or relatively speaking, not moving so much. So the DEES contract is getting priced to the point where it could even come to zero, where you will see this market trading at 1991.5, and GC Feb 2021 barely moves. So now if this were the market here, 1991.5, 1991.5, the calendar spread would be zero. And the inverse is true for a widening calendar spread in contango markets. If sellers come in to December or buyers come into February without buyers coming into DEES, the December contract will begin trading lower relative to February. And you could see, if 1980 becomes the mid-market price and you have 1992 as the mid-market price in February, the spread will trade down to 12, to minus 12. And that's how you will see a calendar spread either tightening towards zero or widening out away from to a greater negative number in a traditionally priced forward curve. And I discussed that in the book, I believe on page 75. Yes. So here we can see Bitcoin is the underlying market example, but the concept is the same. A tightening calendar spread that is in backwardation will trend towards zero. A tightening calendar spread in contango, going from negative, will go to zero. A widening calendar spread, conversely, in backwardation, will trend towards a greater positive number, because remember, we're taking leg 1 minus leg 2. If we're in backwardation and leg 1 is trading at a premium to leg 2, leg 1 minus leg 2 will be a greater positive number in backwardated markets that are widening out. And to the inverse there, a contango market that's widening out will trend towards a greater negative number. So to use gold here, if we were to begin widening, the spread would be going more negative, which means gold December outright relative to gold February is trading at more and more of a discount. And if this spread was to tighten, then we would see a trend towards zero, and that would mean that gold DEES 20 relative to gold February 2021 is trading at less of a discount and heading towards par. That's a great way to really familiarize yourself with number one, the slang: tightening, widening, contango, backwardation, listed calendar spreads. But number two, just the math behind, and it's simple math behind the lingo and behind the trading terminology. And this also opens up new ways to look at the market. So we're going to now go back to the book, and we'll go back to the forward curve we looked at originally. This was the outright forward curve, which is showing the prices of each contract month plotted on a chart. But we can take everything we've just learned and now create a forward curve for the calendar spreads. So we can do that by taking the outright markets, Jan, Feb, March, April, May, June, in this example from the book, And what's the Jan Feb spread price? Here's the Jan Feb spread. What's the Feb March spread price? Here it is. March April here, April May here. So now we can visualize the forward curve of not only the outright markets but the listed calendar spreads as well. And as opposed to just trading gold DEES 20 outright markets or Bitcoin January 2020 outright markets, a trader can trade the calendar spread and can trade the calendar spread curve. The Jan Feb or the Feb March, March April, April May, May June in the book example. And we call this the basis trade, where you're trading the spread between outright markets, and even deeper, you're trading the spreads between each listed calendar spread. So basis trading is a deeper concept as you progress in futures markets, and it's another way to look at trading and look at the market. So I will briefly show you an algorithm that can trade the basis trade synthetically. And to really understand this concept, you will want to take part in course 201, Building Statistical Arbitrage Trading Strategies, Market Making in Bitcoin and Gold Futures Contracts. This is the book. There's a course that goes with it, just like this one. But we will now demonstrate briefly what I'm talking about in terms of the basis trade. So let's see if I can launch this thing. This is my algorithmic execution portal, which we talk about in depth in course 201 and in the book for Building Statistical Arbitrage Trading Strategies. So what you're going to see here is I'm going to begin bidding and offering the calendar spread synthetically, and I believe the spread I have here is for the gold ACH DEES market, and right now we're looking at DEES Feb. So I'm going to minimize my Feb market. I'm going to minimize my DEES Feb listed calendar spread. I'm going to keep my gold DEES outright. I'm going to pull up a new market for gold October. Come down to my list. Here's gold October. Got it. I'm going to move this over, and I'll pull up the listed calendar spread for gold ACH 20 DEES 20. It's in the spreads, and ACH 20 DEES 20. Here's our spread we're looking for, gold GC ACH 20 DEES 20 listed calendar spread. I'm going to pull this up. So we see the spread here, it looks like a mid-market of minus 11.8. We also see the lower bound and upper bound of the spread since trading commenced for this session. So the spread has been moving around a bit, which is interesting from a trading perspective. So you can run through the math in the gold ACH minus gold DEES market and come up with the calendar spread. So now I'm going to show you how I can trade this thing. And I've built this algo here that's going to bring bids and offers into the gold DEES 20 and gold October 2020 outright markets to synthetically create the calendar spread, which is the basis trade. And to wrap up the algo execution education, if I bid, let's say I bid minus 12.1, you can notice minus 12 is bid, minus 11.9 is bid. If I bid minus 12.1, I will begin working orders to buy the October outright at a discount to the December outright by a factor of $12.10 per contract. And you will also notice offers work in the December outright that will work to sell and then buy October at a discount of minus $12.10 per contract. And on the other side of the market, I'm going to be a seller. I'm going to be a seller at minus 11.7. So I'm going to put orders in up here, and that will work an offer in the gold ACH 20 outright market, looking to buy the December 20 outright market at a premium of minus 11 points, or of a premium of $11.70 per contract. And conversely, I will work a bid in the December outright market that will work to sell October at a discount of $11.70. So I'll show you here real quick on the execution front. I'm going to put an order in here at minus 12.1 and an order at minus 11.7. And you will see these outright markets. I am now working a sell order, a buy order, a sell order, a buy order. I'm looking for this market to give me a good fill at minus 11.7 and minus 12.1 that I can immediately offset for profit. That's called arbitrage. Here I just got a fill. I just got a bunch of fills there. So you look at my P&L here, jump to 40 bucks because I got filled on everything. So it's just the market's just active here. I'm actually going to back up to 11.6 on the offer, see if I can fill there. And I might even back up to 12.2. This market's really moving. So what's happening here is the market is sweeping my orders, and I'm getting good fills. And this is an example of statistical arbitrage that we talk about in course 201. So there is your part 2 calendar spread for the video series found within course 101, Introduction to Futures Markets. Thank you.